So when we're looking at the accounting equation, this area here we can consider more of an explanation or an expansion of the accounting equation for the equity side. So remember the accounting equation, assets equals liabilities plus stockholders' equity. And so what we have here is a more detailed understanding of what's taking place on the equity side. So remember, in the previous video, we talked about the accounts that make up the equity area. We have the contributed capital, and then we have the operating capital, which is our retained earnings. And these are the accounts that we're going to focus in on for this particular chapter in this course. So when we apply it all in one, we can see here is our assets equals liabilities plus equity. And this is the only, it's so annoying, this is the only component of the accounting equation that has to be expanded out, equity. So notice we have the contributed capital, which functions as our common stock. Notice that any increases in dividends does what? What is this sign here? Let me get my highlighter here because I need for you folks to see this. Okay. What is it doing? Oops. What is it doing here? It is decreasing. It is decreasing, decreasing, decreasing. So as dividends are issued, they decrease equity. Please get that, folks. Write it down. So the more dividends that I issue out, the more it reduces my equity. That's kind of like, how do I say this? The more that I give kickbacks to the stockholders, well, the less I have retained. You know, because remember, their contributed capital is right here. So if this is saying plus, 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 and I keep turning around and going at the back door and saying, oh, here you go, here you go, here you go. Well, yeah, I'm decreasing. Revenues have a positive impact on equity. So the more I sell in goods or services, the more I'm building up my equity. So that's why you have the plus sign in front of that. My expenses have the opposite effect. The more I have to pay in utility bills, the more I have to pay in the cable bill, the more that I have to pay the cell phone bill, the more I have to pay for this, that, and the other to run my operations, it's depleting my equity, and thus I have the minus sign in front of it. Please note again that this makes up the retained earnings, red, revenue, expenses, and dividends, and thus our operating capital. So let's use the equation as a tool. Let's see how this works. Arrowhead Delivery Service is owned and operated by Gates Dieter. The following selected transactions were completed by Arrowhead Delivery Service during August. So we received cash in exchange for capital stock, $25,000, paid creditors on account $37.50, billed customers for delivery services on account $22,400, received cash from customers on account $11,300, paid dividends $6,000. Now, with that being said, indicate the effect of each transaction on the accounting equation elements, on the assets, the liabilities, the stockholders' equity, the common, which is common stock, dividends, revenue, and expenses. All right, let's do this. Let's do this. So, let's go back. So we received cash in exchange for capital stock, $25,000. So how does this impact the accounting equation? Well, we know that assets are increasing because $25,000 of cash came in because someone wanted to own $25,000 worth of stock. They purchased $25,000 worth of common stock. So cash is increasing, which is an asset. And equity is also increasing because of common stock. You see that? All right. In the next one, let me go back, it says that we paid creditors on account $3,750. So what are the two accounts impacted here? Well, let's see. We paid creditors. Paid means cash went out. And then on account means liabilities because it says creditors on account. So we're paying down a debt. So cash is going out and we've paid down some debt, which is a liability. So let's see what that looks like. So cash is decreasing by $3,750. And our debt liability, accounts payable, is also decreasing $3,750. Okay, let's take a look at another one, the next one. Billed customers for delivery services on account. Now, it says billed. Did we get paid? No. We billed them. They didn't pay us in cash. And what do? We provided delivery services on account. So, in other words, we billed them. They didn't pay us. That's why it's on account. So, we're waiting to receive. That's accounts receivable. But we did provide a service for them. We did work, didn't we? Yeah, we delivered the services. We did work. We earned. So that's revenue. All right, so let's take a look at how this works. So accounts receivable is increasing, not cash, but accounts receivable because we didn't receive cash. So we're waiting to receive the $22,400. And then revenue, which is an equity account, delivery service fees, is also increasing because that's what we earned. We did the work, didn't we? We delivered the product or delivered the service. $22,400. The next one, received cash from customers on account, $11,300. So we received the cash. We got the cash from customers on account. So we didn't do anything to receive this cash. This is cash that we've already did something for. We're just waiting to receive. So accounts receivable is impacted here because we received the cash from customers on account. They already owed us this money. So let's take a look here. So cash is increasing. We finally received the $11,300 that they owed us. And accounts receivable is decreasing. Why? Because that customer no longer owes us that because now they're paying it to us. Okay. Last one, paid dividends, $6,000. So paid, cash went out because it said paid. And what is the other account impacted? Dividends. Dividends. So cash is decreasing because we paid out the $6,000 in dividends. And so dividends is increasing because it is a running account. It keeps track of all the dividends that we've ever issued for that time period. And so the more dividends we issue out, the more we accrue that. We keep a running tab of that. So notice here that every transaction impacts at least 2 accounts. So number one, each transaction impacts at least 2 accounts. Okay? And those accounts are either going to increase or decrease. Sometimes they will both increase. Sometimes they will both decrease. And sometimes only one will increase and sometimes one will only decrease. But you will have at least 2. Sometimes a transaction will impact more than 2 accounts, but each transaction will definitely impact at least 2 accounts. So let's look at this in a more visual way. That we'll just do this one. J. Scott invests $20,000 cash to start the business in return for stock. So that's a transaction. This person invests his own money into the company, and in return, he becomes an owner. He gets common stock. So notice here that this is from the business perspective. The business's assets increase. Cash was coming in, and common stock was issued, $20,000. So both are increasing, and so look at the equation. They're both balanced, $20,000 on both sides. So another transaction, we purchased supplies paying $1,000 in cash. So instead of purchasing the supplies on account, he went on and paid in cash. So what are the two accounts impacted here? Cash and supplies. What is cash doing? Is it increasing or decreasing? It's decreasing because cash is going out to buy the supplies. Well, what about supplies in the business? Is it increasing or decreasing? It's increasing. Why? Because we didn't have supplies before and now we have $1,000 worth of supplies. So notice how that impacts the accounting equation. Notice that we are still balanced at $20,000 on both sides of the accounting equation. Purchase equipment for $15,000 cash. Another cash transaction. So instead of purchasing the equipment on account, decided to pay $15,000 in cash for it. He's about to run out of money. So what are the two accounts impacted here? Cash and equipment. Cash is decreasing, equipment is increasing in the business. So we didn't have equipment before, now we own $15,000 worth of equipment, and we had $15,000 in cash, now we don't, as we use it to purchase the equipment. We're still in balance, but we're cash strapped. Look at that. We only have $4,000 left. We need to do something quick. We need to make a sale, don't we? All right. Purchase supplies of $200 and equipment of $1,000 on account. So somebody said, "Hey, we can't use the rest of that $4,000 in making all these purchases. We need to buy this on account. We need some time." So notice what they did. So when you're talking about the purchase of supplies, the two accounts impacted there because it was purchased on account, not with cash. Supplies increases. Our debt increases because when we choose not to purchase with cash and we purchase with a line of credit, that's debt. We also purchased $1,000 equipment on account, so the equipment increased in our business and so did our debt, accounts payable. So notice that supplies, we have an increase of $200 there, an increase of equipment of $1,000, but we also have a collective $1,200 increase, $1,000 plus $200. We've got some debt now. So not only are we cash strapped, now we have debt. Dude, what are you doing? Can we make a sale yet? Oh no, we're even worse now. So now we borrowed $4,000 from First American Bank. Where's the sale coming in? So we borrowed money. We got more in debt because we needed more money. We borrowed $4,000 from the bank, so that's a notes payable. So now we have $5,200 in debt. We have $8,000 cash, and we have $1,200 in supplies that we own and $1,600 in equipment that we own. We have issued out $20,000 in ownership stock, but we still haven't made a sale. Notice that we're still in balance also. So the balances so far appear below, so that's what we kind of went over, and we are still in balance. Now let's look at transactions involving revenue, expenses, and dividends. So providing consulting services, receiving $3,000 in cash. So finally, we have earned some revenue. Good grief. We earned revenue by providing services to a customer, and those services were worth $3,000. So remember, we always record the revenue once we've earned it, once we've completed the task or the service or delivered the product. In this case, yippee, we were paid immediately. So we got the cash. Notice that cash increased by $3,000 and revenue increased by $3,000. Revenue is an account that always will show us what we earned for that time period. So it's always increasing, okay? And so we balance out at $28,200. Then we have paid salaries of $800 to employees. So money's going out. We got to pay our employees. They worked. So cash is decreasing. So that's one of the accounts. The other account is expenses. We paid them. And that is showing as a decreasing. Now I don't remember that expenses decrease our equity. They decrease our equity. $500 of dividends is paid to our stockholders, and so cash is going out. Dividends is also going out. Notice how they both decrease both sides. This transaction decreases both sides of the equation.